All right, hi everyone. Welcome to our next episode of Free Lunch. I am excited to be chatting with you today, and of course, joined by my co host, the one and only Mr. Ken Gishinga. Ken, say hi to the people.
Hi, Kim. Great to hear from you. It's a great Thursday, and I'm looking forward to a wonderful episode of Free Lunch as we build up from what was a very interesting conversation last week on MSMEs.
I agree with you. That conversation was really powerful, and I really liked the feedback that we got from the MSMEs. And it just goes to show that there's nothing. It's one thing for policies to be enacted, but then how individuals, how households, how businesses are coping at the end of the day is incredibly important to what comes next, especially as we are envisioning turnaround strategies and revamping economies during these difficult times that we're in.
Absolutely. I think one of the reasons maybe it caught a lot of interest is because SMEs really contribute such a big chunk of our GDP, and almost everybody knows somebody within their network who is within the SMEs segment. But one thing that maybe last week we quite didn't define, it's one of those words that are broadly used, and it's almost like that economics book by Adam Smith. What
Right.
everybody quotes, nobody's read.
Right.
The
Correct.
Wealth of Nations, and
Correct.
everybody uses the word SMEs. And I just wanted to hear what's your definition of. It used to be called SME. Nowadays, it's more MSME.
Right. I mean, it's such a good question. And, I even wonder, given everything we've seen now, whether we are really talking about MSME or MMSME, like the micro of the micro, small, and medium sized enterprises. But yes, I think these are people who are not necessarily formally employed, running their own businesses. They might not be registered. And so in Kenya, there are about, or at least based on the latest statistics, as many as 6 million MSMEs, who most of whom are unlicensed and operating at a household level. But for me, I think of your ordinary informal person on the street who's running a business that employs less than 10 people, likely doing petty retail or doing odd jobs. It reminds me of the height of our primary school experience and how we learned about sole entrepreneurs, small,
Right.
that sole proprietor, maybe a small partnership, and largely relying on family income or sorry, family labor. So, your father, your mother, your brothers and sisters are contributing to the business, and oftentimes profit might not be the strongest component of the business. It's mainly a way to keep people employed and engaged in some meaningful activity. But Ken, you're the economist here. When SMEs or the concept of MSME comes to mind, what do you think about?
I think that's a great background that you've given. I've interacted with this phrase in different sectors. In my previous life, I was in the banking sector,
Yeah.
and for them, it was the size of the loans that
Mm,
you would qualify for, and the revenue that you
right.
generate as a business. So you find most banks would have an SME department, a corporate department. So it was
Right.
really tied to the revenues, your cash flows, how big ticket loans you would. But from a policy perspective, and this is where the government plays a big role. And
Yeah.
there was an SME report that was last done in 2016,
Yeah.
and they have a interesting definition where it's really about the number of people.
Yeah.
So for them, a micro enterprise would be something between 1 and 10 people. Is
Mm,
an entity that hires between 1 and 10 people. What they call small business would be between 11 and 49
mm-hmm.
people. Then the medium part would be like from about 50 to 99. And I
Yeah.
thought that was an interesting definition, because in some other countries, they consider anything less than 250 employees
Yeah.
to be an SME. But in Kenya, when you talk about micro, it's really from the 1 to 10%. And surprisingly, that accounts for 92%. When
Yeah.
you take the whole MSME bucket,
Yeah.
92% of those micros of less than 10 people, about 7% are in those small entities between 11 and 49, and almost a point 1
Yeah.
that's above that. So it shows you, even as we say MSME, we are
Yeah.
overwhelmingly skewed towards the micro,
Yeah.
less than 10 people types of businesses.
Got you. I know, without making this too philosophical, I even wonder whether, because of COVID, some of these definitions really need to change, right? And maybe we need to define industries based on their level of resilience. Because, you might be
Mhm.
a 1 to 5 person company and you're incredibly resilient. That calling you
Right.
an MSME just feels like a slap in the face. Whereas, a 51 to 100 size SME that's not very liquid, or didn't manage to go through COVID successfully, it feels like maybe that's less important at that point. I wonder whether COVID will force us to rethink about these definitions and really be or exert some sort of clear weighting around this issue of resilience. Because I would argue the more resilient you are, the you really should have a stronger, you should really be thought about differently from your peers. But nonetheless, that could be a very interesting conversation for another time. But I'm curious, if we think about like the credit guarantee scheme. So we have that 30 million allocation that the government, $30 million that the government allocated towards this credit guarantee scheme to de-risk lending for MSMEs and also to support MSMEs to access credit during this period. I know we've had previous conversations on whether this was successful, whether this is sufficient, whether as a stimulus package this is sufficient. But Kian, I'm curious for your thoughts around the idea of this scheme, and what does it mean for the ordinary MSME? Last week we talked about, maybe not all the MSMEs will access, but let's talk about today. Like, if they actually do access, what does that mean for them? What does that mean for their businesses? What are the implications of this credit guarantee scheme that's in place?
Well, indeed, I think, Kim, that's a very valid question. And I think what's making this scenario unique is we are going through a very tough macroeconomic situation right now,
Yeah,
where we don't have much liquidity in the economy and there isn't much going on.
yeah,
And I think even prior to this episode, one of the things that you had alluded to
mm,
was, is there strong demand in the economy, even if these MSMEs will be able to reopen, assuming next week everything is open? Is
yeah,
there strong demand? And that's what I've always said. First of all, we need to have a very strong macro stimulus, a monetary stimulus across the economy to get people buying and selling and transacting. Then the SMEs now can sort of be able to tap into the credit guarantee scheme, because my fear is, assuming we reopen next week and
yeah,
all these nice little restaurants open up, they might not have clients because people don't have the purchasing power. A lot of people have gone 3 months without being paid an income. They can't afford rent, they can't afford food, they can't service their loans. So expecting that businesses will open their doors next week and people will come running in because of pent up demand, I
yeah,
think that's almost a bit naive. So I think there's a macro part that has to be addressed. But when it comes specifically to the
mm,
MSMEs, definitely it will have to be sector by sector,
yeah,
because some sectors have, like hospitality and tourism, have taken a much greater hit and will maybe take a longer time to rebound than other sectors like ICT, which have kind of almost been thriving during the COVID case. So I think it's really partnering with the banks, and I think banks
yeah,
would be an ideal partner because it's very difficult for government to be able to do credit scoring and stuff. So if they can sort of partner with the banks, almost similar to the way we saw World Bank lending to Equity Bank for
Mm,
onward lending, I think that might be sort of a more strategic way. But I think back to the first thing is there strong demand, first of all,
yeah.
for these businesses to be able to repay back these loans?
It's such a good point because when you talk about demand, you're talking about the ability for people to go out and exercise agency, consume goods and services. And from my perspective, I start thinking about behavior change. And I think the last couple of months, the government has really hammered on this need for us to change behavior, to exercise social distancing. Let's flatten the coronavirus curve. Let's make sure we can protect each other. And so all those raft of measures that were initiated, for example, and all those raft of measures initiated have helped to keep to keep the curve flattened to the extent to which they can. But that has had a significant blow on demand, right? So you're totally right,
Right.
and I agree with you that we're in a very weird, slippery slope in that the MSMEs and SMEs more broadly were surviving, and even one wonders how well they were doing. So, some statistics that I looked at suggested that, in 2018, less than 20% of all loans actually went to MSMEs. But somehow they were inching along. And so COVID came and so more or less extinguished that little budding flame that was on. And so now we're coming back and saying, okay, here's a credit guarantee scheme, $30 million. MSMEs can access. However, you must be registered by a county government someplace. You must have a valid business permit or trade license. And that, helps to address the issue of unlocking capital. But like you've rightly said, people already now are, cognizant, or at least have been educated and forced to think about, working from home, social distancing, keeping away from crowded areas, etc., not necessarily eating in public places, which then that has sort of created and shifted how people are demanding services. Of course, you would argue that maybe if you're talking about restaurants, there's the opportunity for deliveries, but nonetheless, not every restaurant can afford that, has access to that. And if you think about the other MSMEs or the other businesses that fall into this MSME category, like the Juakali sector or the informal sector, they've not had the luxury of working from home. They require people to show up. Your vegetable seller, your grocery seller requires you to come out of your house and go and purchase. So like the entrepreneurs talked about last week, we really need to think about how we support them. But I also feel like even the credit guarantee scheme, if you discount the demand issue, if you assume that even the demand would spring back because people have gone through quarantine fatigue and they actually want to go out and be about their business, can this supply of $30 million into this credit guarantee scheme that's been injected, is that going to reach the smallest MSMEs? And do they actually qualify? Do these 6 million unlicensed MSMEs want to automatically become licensed so that they can go after this credit guarantee scheme? Or are there other things that are holding them back?
Kim, you've touched on a very powerful point on behavioral change. And
Mm,
I think this is an area where you're an expert, and maybe you can be able to expound on this more. But
mm,
you've been able to touch on two important things. There is what you call aggregate demand, and this is
mm,
really tied to how much money is in your pockets.
mm,
But there's also behavioral change. So there'll be some people who they haven't lost their job, they haven't lost a salary, but their behavior has just changed.
yeah,
So they might not demand. So when one of the most common SMEs is in the motor vehicle industry, where you have garages,
yeah,
where that garage guy who comes and fixes your car.
yeah,
So you realize most people are working from home. So I'm assuming your car needed to go for servicing.
yeah,
A
correct.
lot of people might say, uh, well, I can postpone it to next month. After all, I'm working from home.
You're right.
Um, and I'm not using. Actually, I've been using Uber
Yeah.
quite a lot. So you'll find people who, yes, they're not even affected in terms of like monetary demand, but their behavior has just changed, so
Yeah.
they're also demanding less. So you realize in this bucket called demand, there's a monetary part and there's
Yeah.
a behavioral part, and maybe you can speak to more of those behavioral changes you
Yeah.
expect.
No, absolutely. And I think, traditional economics sort of lumps these things into useful buckets for us. So, there's everything to do with, where we started this conversation with people having lost jobs and people having been affected by COVID. There's certainly a strong substitution effect. So people are like, okay, all right, let's first start off with the income effect, right? So I've lost my income. I'm no longer able to afford the normal goods and the normal basket of goods and services. So I need to downgrade. So that also then forces you to create new behaviors around coping. So you will then start having, substitution effects showing up. So you'll likely start saying, okay, you know what, let me not eat 3 times a day, let me eat once a day. So that also affects demand at an aggregate level. Let me not go spend outside my home. Let me actually stay home. Let me consume the little food that I have in the house versus go out and order. And of course, on the flip side of that, you have people who maybe have not been as affected, and they're saying because of the crisis, let me stay home and order as opposed to cook. So that also shifts the demand for goods and services in a slightly different way. So I think some segmentation there is certainly important to understand what individual decision making is looking like. But certainly a whole bunch of drivers come into play. So the idea of the status quo bias comes in. If it's all of a sudden it's a cool and aspirational thing for us to order in because we can afford the takeout, if you have enough people doing that and that creates a good enough social norm, folks will start doing that. But I think if you look at the average Kenyan and below, if you look at folks who are really the informal sector who are struggling to make things work, to make and to put food on the table, they are facing different challenges. So for them, they're substituting between paying rent and paying school fees and putting food on the table. So that's also shifting household demand in very interesting and unpredictable ways. And like you said, like the small businesses are definitely facing these huge effects. It's funny you talked about the garage example. So I know, for example, I've been delaying my fixing of the car largely because I'm saying, okay, you know what, the car can survive a little bit longer. We haven't been traveling as much or as far, and so you sort of rationalize. At least I'm rationalizing in my mind and saying, okay, you know what, the car can survive. It can hang in there for a little bit longer, but perhaps there actually are more pressing immediate concerns. So the bigger companies can survive those shifts in demand and those substitution effects that individuals are making. But certainly the smaller MSMEs will face challenges. And the interesting thing about this credit guarantee scheme, to be honest, is the fact that if somehow we could change the behavior of MSMEs to actually go get licensed, there's an opportunity for them to engage. But again, if you think of nearly 6 million MSMEs, divide that by $30 million, assuming all of that goes through, that could be about $5 million per MSME. Then the question is, are all those MSMEs accessible and able to access that credit because of the nature of their business, because of their track history? Remember, many of these are operating at a household level. So it could be tricky, especially if they don't have even the assets to be able to show up and support their activities. I worry that there's still going to be an access issue there. There's going to be a gap there. And, like one of our MSMEs last week rightfully mentioned, there is likely to be gaps in how well this policy will reach the most deserving or the most urgent of cases.
Right. if the government plans to partner with commercial banks to apply this credit guarantee scheme, obviously it will be the banks will the banks will be able to sort of like determine what are the typical loan amounts that would be required. And when I read about the deal between the World Bank and Equity Bank, I saw the loan tickets would go from anywhere from maybe $1 million to almost 300 million. Now I need to check the actual numbers. But as you say, there's an income effect and there's a substitution effect playing. And the one can only ask the credit managers and the credit analysts, how will they be able to, assuming you have 10 of these SMEs coming to you, how will you be able to sort of measure how businesses will be impacted by the substitution effect? Would you say that, Kim, your business is a big substitution effect that will disrupt your business? Right. So unfortunately, I can't lend you amount of money, or do they have the skills to be able to say the demand for your goods or your service is perfectly inelastic, so Correct. We do know people will come and repay you. So I don't know if those credit managers have that toolkit to be able to sort of assess this.
I love it, and you're asking all of the right questions. And when I think about it, to be honest, your background was in a traditional bank, retail banking experience. I dabbled a little bit within the microfinance sector, and the same questions would sort of cut through. And my experience within the micro space is that if you had, let's say, $30 million to disburse, you would be trying to think, how do I give as many businesses a share of this money? So you're trying to think about how do you cut it and disburse that amount of money to as many people as you can. So of course, you're still trying to think about the income and substitution effects from all of these different entities that you will be lending to. But I always sort of felt like the smaller lending institutions had a stronger handle on trying to divvy up the pie across as many people because of the profitability and hedging risk. The bigger banks would, of course, rather want to say, okay, you know what, I'm not going to manage 10,000 relationships. Let me manage 100 relationships, but then give them a bigger size of the chunk. So then I feel like unless then the banks also make a concerted effort, it's a lot easier. If I'm a credit officer, my incentive is to disburse the $30 million, right? I don't know if I have KPIs for how many individuals I give the money to. Certainly, I know I have a KPI on like how much of this money I do disburse. So if I can come and find an off-taker who will take $27 million right off the bat, I'm like, super, awesome, take it and go, right? Whereas, and that of course then would not likely have very strong mainstreaming effects for your smaller MSMEs. So as much as then the solution would be there, if assuming all the 6 million MSMEs could actually convert to being licensed, I worry that they would still face another challenge, which is, again, very behavioral, that, status quo prevails. I'd rather give it to the big boys. I know them, I trust them, I have a relationship with them. You are small, you're new, why take a risk? And I'm also risk averse. So I can imagine a credit officer saying, no, let me give it to a stronger business. Let me appraise this business that has longer track history. And so that could be a very different dynamic. But to the point that you made, I mean, the bank that you cited is, also has a very strong pro-poor bias track record. So likely there are ways, once those funds land within the system, they'll find ways to allocate it across, your big firms, your smaller firms, etc. But I still worry that even still, those small firms, those 6 million MSMEs that are operating at a household level, would be scared about formalizing, because there's some advantage, if you will, to sitting in the shadows and not necessarily being visible to the exchequer. even though the exchequer is slightly hoping, one could argue that exchequer is slightly hoping that, these MSMEs will want to get registered, want to become formalized, and then ultimately pay the 1% turnover tax.
I completely agree with you. And I think many of them will still prefer to operate in the fringes. They derive excessive benefits when they do that. And the question of how do we incentivize them? But even without that part of them being brought into the formal system, another thing that many MSMEs worry about is the subjectivity of the credit approval process. And I know one particular SME who told me he was applying for a loan for about 2 million shillings and had a relationship with his bank for about 3, 4, 5 years. And they declined his application. And then he went to the next bank down the street. He not only did he get what he was looking for, they actually awarded him almost 6 million shillings.
Wow.
And stuff. So I think it shocks that credit scoring today, and then I'm sure you have more insight in the credit process, but it seems to me that even in 2020, it's a very subjective process. And I know we've talked about behavioral monetary policy, but is there some element of behavioral credit appraisal?
I like what you just said there, because you're already, you're touching on some very interesting notes that I observed when I visited some of our more retail oriented banks, in that, there are some additional costs and penalties that are implied and applied because you're small in stature. So if you're a small organization, a small outfit, you're an MSME, you're a mom and pop business, 5 employees or less, the service that you can access is at a mass market, right? So you'll walk to your branch, you'll sit on your chair, you'll have your credit officer and loan officer sitting opposite you. And, a conversation will be hashed out in public around your ability to repay your debt. And I remember eavesdropping into one of those conversations, and I felt like this was so inappropriate, because you literally can't be haggling here, in full view and with everyone listening in to this conversation. And the MSME in that case was trying to apply for, it may have been even a it was a $1,000 loan or $3,000 loan at the most. And he's getting a dress down from the loan officer telling him that, look, you don't quite qualify. I see your account has not been in good standing. There's an overdraft facility that you didn't quite meet. So there's the dignity of the MSME that's just eroded in this conversation, and also then affects their confidence and their ability to exercise agency. And then when you think about like the bigger boys who can access, the prestige banking, they can access, the higher level, they might even have a relationship officer come to them to discuss their credit needs. It's already a very different ball game all of a sudden, right? Like the bigger businesses, will have the ability to pay more, to command more, and also will get better attention. But even as I say that, there are, a number of microfinance institutions that are, have deployed their loan officers to go and have one-on-one conversations. But sadly, this credit appraisal process, as long as it's human, there's some human involvement, then you open up the doors for biases to play in, right? So as much as even the micro loan officer will go out to talk to a small SME and try and explain to them their options, that the rates, etc., it's human. The individual will think, you know what, let me give more to a business that looks more stable, that, like you said, maybe the elasticity of demand for their products will help them leverage and make their way safely through the crisis. Whereas the other business, is more at risk. And it might speak to something that we've talked about probably in previous episodes of, can you do this credit scoring business in a way that doesn't involve as much human intervention? Maybe we're talking about advanced blockchain technologies, some machine learning techniques, artificial intelligence coming into play. And I was really excited because of that fact when digital lenders came up, because the digital lender is appraising me not because they've seen me, they like me, not because there's an element of bias because I know the loan officer or I know the financial institution. They're looking at my transaction history, but then also, and ideally that should be a fairly um, unbiased process. But of course, you could argue that it's a human being that's written the algorithm, so there are some implicit biases already in there. But nonetheless, you would imagine that would be a fairer system. But then also for other reasons, the digital lenders aren't also lending as much as they could during the crisis. So it's a bit of a double hammer that the more objective opportunities for the MSMEs to access credit in a way that wouldn't lower their dignity has also been taken away because of the crisis.
Very, very, very interesting. And I wish even maybe next time we could have a couple of credit analysts maybe giving us one or two takes from the experience. I think it's a very fascinating thing that involves both economics and psychology and even bias, as you said, that is implied on that. So this is incredibly insightful for me too.
Correct. And the other thing that you've just talked about there, and even as we try to wrap up this episode, is this idea of I guess traditional banking has always had a little bit of implicit bias in there, right? So when you're walking up to your loan officer, you've cultivated a relationship with your loan officer. And so, whereas that's a boon, that's a benefit when it comes to you getting an appraisal, it also means that he's less likely to cross every T and dot every I because you've developed a relationship. So then maybe what we're talking about is COVID is creating an experience where we do need to debias the credit appraisal system so that, yes, the KYC requirements are important, but we still need to make sure that as much as there's KYC, you know who you're lending to. You debias the individual and the decision to lend to them because of the fact that you have those relationships.
Absolutely, absolutely true. And Kim, when we started on this episode, we talked about the definitions of SMEs. And I told you about the bank's definition that does with the loan size or the government position that deals with the number of people. But surprisingly, one important dimension that I think nobody is paying attention to has been the duration in which that entity has been in business. And for me, even as a business owner, what I've noticed is the first 4 years is when your business model crystallizes. You almost need almost 4 or 5 years before you crystallize your business model. But banks tend to like lending to entities that already have an existing business model.
Right.
So I think the question we should have been asking is, should this money be going to a commercial bank or should it be going into some venture capital? Because I think venture capital tends to do much better with businesses that are still pivoting and evolving and that. And I think that's like from 0 to 5 years. And maybe from 5 years onwards, when you have a very consistent business model, banks do those very, very well. So I wish we could have an extra column in that criteria that really talks about the duration, because you'll have a business that has cash flow. You'll have somebody who has a chemist, and if you look at his bank statements, his cash flows, but maybe the cash flows are coming from rentals or they're coming from other industries that are not related, yet you're lending because you're seeing cash flows coming in and out. I think there's a whole industry that is very apparent in the US, but is not yet very developed in Kenya. And I think that's the angel investors, the venture capital, the private equity. I think those tend to do much better with small businesses that have an evolving, that are still pivoting.
It's such an interesting conversation you've sparked on, and I think we probably should think about this for a future episode, which is, what you're talking about has really been the reason why the paygo sector has really taken off. So for our listeners who may not be familiar, so paygo is built around this idea of you can pick an asset, a productive asset, ideally something that will light a few rooms, probably has an entertainment component, so you can have TV in an off-grid home, and then you pay the solution over time. So you take a small deposit up front, you pay a small deposit up front, you get the solution, and then you repay it over time. And so, because there's really been no tried and tested model for this, the main investors for this system have been angel investors. And that industry has completely scaled because angel investors, one, have been excited about the strong impact, because these devices are reaching people who live in the last inch of the last mile. So they, are likely to be unserved by the national grid for years to come. And then also, it has a really strong poor outcome, because now it means that these rural homes, kids can continue studying, they can learn, the security, they can be productive, so earn an income. So those types of customers and those types of businesses haven't really been served by your traditional credit, but mainly by angel investors, and that's scaled and taken off. Of course, though, one challenge of those models has always been where is the value of the business? And of course, this might be a very interesting tangent, but one ongoing criticism has been, is that paygo company, are they an asset leasing company, or are they a financier? And so they've also gotten into the bad books because they typically are lending at higher rates than ordinary. So, what does that mean for the actual outcome for these low-end homes, or low-end consumers who are living in very far-flung places? But I think the point is, really well nailed, in that what support is there for the MSMEs who've just started, who, it takes a while for them to establish their business model. I mean, the credit guarantee scheme was ideally also helped to make, or to de-risk the big banks from lending to these MSMEs. But you're absolutely right. Like, for some of them, they may not make it, or their business models may evolve over time, which, I guess is also part of the problem and part of the concerns, where when the exchequer, for example, is trying to introduce a 1% turnover tax to attract, trying to make sure that these MSMEs attract a 1% turnover tax on their revenues, you end up with the same problem. What revenue are you taxing? Are you taxing the revenue that they're generating from sales or from rent? Because they're still trying to figure out what's their business model, or what's sustainable, etc. But I guess, no easy decisions can be reached immediately in the short term, but we certainly have a scenario and an opportunity to try and address the issue if we can have a bit of a more holistic approach. I think I'm motivated by the fact that the potential is huge. 6 million MSMEs are unlicensed. There's more that can be done, surely, to net some of them. Of the 1.5 or 1.6 million of those that are licensed, how can we help them so that we are not stealing, if you will, their seed capital by taxing it, but helping them to reinvest it so that they get beyond that 3-year, 4-year hump, and then they actually have enough to graduate into SME and large taxpayer category, so that then, we're not looking at, our tax revenues being at, their 5-year low, but we can enable these small businesses to grow, and for us to get out of the funding quagmire that we're in now. So Ken, we've been talking for ages and ages. Curious if you have a way to wrap this conversation up, because it's really getting more and more interesting as we get into it.
No, absolutely. This is something that we can talk about for many episodes, because it's such a dynamic industry with so many changes. Even when you talk about those new developments that are coming in right now, then you have also the BBI proposal that is proposing tax breaks for the companies in their first 5 years. So you wonder if you're a recipient of this facility and the BBI proposal goes through, do you just like stop paying? It's
Right, right.
it's it's a very it's an interesting spaces there. But
Correct.
definitely, I've always believed that the entrepreneur there are four factors of production in economics. It's
Yeah,
land, labor, capital, and lastly, it's the entrepreneur who brings all these things together.
correct.
If we can create an economic model where the entrepreneur is really at the center of it and
Right,
you're really encouraging it, I think
right.
this would be something that would create great wealth for this country. So I look forward to seeing how this plan will be rolled out. Hopefully, next time we'll have some documentations to see maybe
Sure.
some things. I don't know if they plan to roll it out with banks or individually.
Mm,
So very, very interesting space to watch.
correct, absolutely. And I think we can end it there. Looking forward to seeing how things unfold in coming days. But to our loyal podcast listeners, that has been our episode on the Credit Guarantee Scheme. $30 million that's been allocated to support MSMEs. Hopefully some of them will become included and support support driving the country's goals of increasing tax revenue. But all of that remains to be seen, and whether or not the money is lent. I think there's a fundamental question, and Ken's talked about it on this idea of unlocking demand. Can monetary policy play a stronger role? So that's our time, people. Thank you so much for listening. We look forward to having you on our next episode. Ken, take us away.
Thank you so much, Kim, and thank you so much for our audience for your generous feedback. Always willing to listen to your comments. Feel free to send us through our social media handles your feedback, any future topics you'd like us to talk about. We are always very agile to new topics. For me here, I wish you a great weekend and keep safe and keep well. Bye-bye.
Bye.